All right, good morning, everyone. I'd like to thank everyone for joining our webinar today on behalf of Corrigan Krause. My name is Aaron Apathy. I'm a director in our Assurance Services Department. Back in March of 2020, we formed our coronavirus crisis team. Today, I have several key members on the team as panelists to go through the recent Consolidated Appropriations Act. There's some key highlights and overviews that we'd love to dive in, give some insight as we know how things stand today. Again, with everything related to this, it's an ever-changing topic and area. What we know today could change tomorrow. And with the forms being released and coming forward, so with everything being said, we encourage everyone to take in the information today, connect with their appropriate advisors, and take appropriate action moving forward related to every and all topics we discussed today. As I said, I'm Aaron Apathy, a director in Assurance Services, and have led up our task force team here. At this time, I'd like to introduce our other panelists, starting with Doug Rames.
Hello, everyone. I'm Doug. I am, like Aaron said, I'm a supervisor in the Assurance Services team. I've been working with Corrigan Krause for about a year and a half now. So I've been working the construction niche as well here at Corrigan Krause, but I've been working since March, really, a lot with helping clients with CARES Act and the programs that are available to companies out there. So looking forward to helping out any way we can.
Hi, my name's Tommy Soster. I'm a senior manager in our ASD group. I've been with Corrigan Krause since March of 2020. Prior to that, I spent time at Ernst & Young and BDO. I have about 14 years of public accounting experience. I've been helping in the COVID crisis team here with loan applications for the PPP loans up front, compliance with the loans, and then helping clients with the submission of their forgiveness process. My background is working primarily in audits or reviews, specifically in the manufacturing niche primarily. And I'll let Derek introduce himself.
Okay. Thanks, Tommy. I'm Derek Solomon, and I'm one of the co-leaders of Corrigan Krause's consulting department, where I focus primarily on business valuations, succession planning, and other consulting services. And as our crisis team came together as the pandemic began about 9 months ago, we've had a main focus on the PPP and the forgiveness process and various other opportunities for business relief originally in the CARES Act. So as Aaron indicated, it's been a continually evolving and often confusing process over the last 9 months. And certainly now as we get into phase 2 of the business relief opportunities, there could potentially be more confusion, clarifications as this process starts to evolve from what is developed with the act that passed in Congress a couple weeks ago. So we're happy to provide some clarity to you based on what we know so far. And with that, I'll throw it back to Aaron.
Thanks, Derek. We have a couple friendly reminders we want to go over. We have Megan Hiles on here, our business development and marketing manager. So Megan, if you just want to let our participants know a few reminders as we move forward.
Sure. Hello, everybody. Thank you for joining us today. As Aaron mentioned, I'm the Marketing and Business Development Manager at Corrigan Krause. Just wanted to go over a couple housekeeping items before we dig into today's presentation. Please submit any questions that you have using our Q&A feature on the toolbar. We'll be monitoring that. We want this to be an interactive discussion, so please submit any questions as you have them. I also want to let everybody know that this is being recorded, and we will send everybody who registered for today's webinar a link to the recording tomorrow with a short survey. So thanks again for joining us today.
Thank you, Megan. Our agenda today, is overview of the latest relief package. So talking about tax deductibility for PPP expenses, the PPP2 funding that's out there. Talking about FFCRA and employer retention tax credit, a deeper dive into PPP2, and then some other individual and business provisions related to the recent bill. So, starting off, we'd like to dig into one of the most important changes is the tax deductibility related to the PPP. So, Doug, can you give a little insight to our participants on the tax deductibility?
Sure. Thanks, Aaron. So the tax, like Aaron said, the tax deductibility is a huge component. Everyone wants to know whether these expenses are deductible and whether the income is taxable. So initially, the way it was set up was the income was not to be taxable. The loan forgiveness, assuming it was forgiven, was not to be taxable. However, the expenses were not tax deductible. Recently, as part of the new legislation, they determined that the expenses will be deductible, which is a major change and benefit, obviously. So in terms of the tax element, there's that. Now, there is also the consideration from a financial statement impact and how that corresponds with the tax implications. So looking from a financial statement perspective, essentially, you have a few different options in how this is treated, and the loan itself can be treated. If you anticipate forgiveness, you can use essentially the governmental grant model. Essentially, is what it is. So you're reflecting these amounts in income, even if forgiveness has not been determined. If you're reasonably assured that the amounts will be forgiven, these can be reflected in your income, and in that case, that would be your book income. And then when it comes time to file the tax return, you will essentially have an adjustment to that to add back that income, as that income will not be taxable. So that's a big change there with that. And then that's the other method from the financial statement perspective. If you're unsure of forgiveness, if you're not reasonably sure that it's going to be forgiven, then it can remain as a liability on the books, on the financial statements. But again, the tax implications have been a huge development. So that's something we've been working with clients over the last several months, really, and it'll continue to develop with the new PPP round coming out in the next couple weeks or so. We expect more information then.
Thanks, Doug. Yeah, it's a huge relief, in the uncertainty that was hanging out there of is this taxable to me or not? So if you get full forgiveness, your expenses can be deductible for you. Again, that's something with PPP2, it will be treated the same way from a tax standpoint. On that financial statement side, understanding the impact it has on your loan covenants. So that's, having a positive impact to your financial statements with that loan forgiveness going to other income, boosting your bottom line for the year. But, understanding that we're still waiting for clarification on lenders on if it can be included in your loan covenant calculations or not. So continue to reach out to your lenders on that. One important comment on tax deductibility is there's still some uncertainty related to basis and how it impacts your tax return. So if this is increasing your bottom line book income and you have non-deductible expenses, but it's unclear if the basis in your company will be increased with this. So we could have some excess distributions happening and causing some tax there in capital gains. So again, connect with your advisor. There should be more clarity on that from the Treasury moving forward. But overall, the taxability is a huge relief for business owners. So moving forward to kind of PPP2, would love to hear the latest and greatest on that, and turn that over to you, Tommy.
Sure. Thanks. So PPP2 is part of this new stimulus bill. So now we get to have more fun with the SBA as far as these loans. And within this bill, there's approximately $284 billion that is slated for PPP 2.0 that is for small businesses subject to certain requirements, which we'll get into a little bit more here. As far as a high level, who's eligible for these loans, it's businesses now with 300 employees or less. If you remember in the last PPP it was 500 employees or less. There's a slight change for that. There's also new this round some additional types of businesses that are eligible for these loans. 501c6 businesses, such as chambers of commerce or a visitors bureau, are now eligible that were not previously eligible. One of the stipulations with those companies is they can't have more than 15% of their gross receipts relate to lobbying activities. But otherwise, they would be eligible for these loans as well. Some specific businesses that are not eligible for these loans are publicly traded companies and some foreign-based companies, or some companies that have foreign-based ownership overall. The real target as well of this round of loans is the restaurants and hospitality industry, and Derek will touch upon a little bit more with that in a second here. And the other thing is everyone's wondering, what's the timing for these loans? When are they going to be available? So the bill just came out in the last 2 weeks or so that was formally approved. Banks have been working on getting their portal applications ready for people to apply. Our best guess is the soonest would be within a week maybe, but it could be the middle to the end of January before the applications are ultimately open. And the timing of when you have to apply for these loans is it's available until March 31st, assuming the money doesn't run out. So the ending date right now is March 31 as far as applying for these. And now I'll let Derek talk a little bit more about the terms of the loans.
Thanks, Tommy. Again, we're going to keep it at a high level initially as we're talking about this now, but the calculation of the loan amount is similar to what happened back with PPP 1, where after a business determines their average monthly payroll costs, you multiply that by a factor of 2.5 to determine the loan amount. Now, as Tommy just said, one of the big changes relates to additional relief for the what's called the accommodation and food services industry, which is based on the what's called the NAICS code. If you're not familiar with that, that's the North American Industrial Classification System, and that there's a specific code 72 that incorporates or encompasses the accommodation and food services businesses. So if you're in that NAICS code, your factor is not 2.5, but 3.5 times your average monthly payroll costs. Additionally, one of the big changes since the original PPP back in March is that to determine your average monthly payroll costs, you can use either 2019 or the last 12 months. So at this point, for businesses applying in January, you have the option of using 2020 or 2019, which could make a big difference in the calculation of the loan amount. For example, if you have a business that had $500,000 of payroll costs in 2019 and $400,000 of payroll costs in 2020, you could use 2019 as the base to determine your loan amount. And effectively, the way the calculation works out, where you divide your annual amount by 12 and then multiply by the 2.5 factor, every $100,000 difference leads to a loan amount difference of about $20,000. So in my example, if a business used the 2019 payroll costs of $500,000, their loan amount would be $20,000 higher. Works out to about a little bit more than $100,000 based on that example. So there's about a $20,000 differential if you have $100,000 of a payroll cost differential if you're comparing the two periods. So again, using the higher amount obviously benefits with a higher loan amount that hopefully ultimately becomes a forgivable loan and additional relief for the businesses that need it. So Aaron, back to you for some more tax credit issues.
Yeah, thanks. Well, I want to address a few questions that have popped up in the Q&A there. Accounting question: if we expect forgiveness, must you take the income into 2020, or can you wait until 2021 when you actually have official forgiveness? Is it required or just better for accounting purposes? So the answer to that is you should be booking the income in 2020. Really, you're matching the expenses that you've incurred related to your PPP round one in 2020, and so the income should be booked in 2020. Second question related to PPP, if you get a loan before, will you have to submit an entirely new application to your lender? So Derek and Tommy will dig into that a little bit more, but the answer to that is yes, you'll have to submit a new application. And the reason why is you'll have to substantiate the gross receipts reduction, period versus period. So they'll have information on file. Hopefully will be easier round two, but substantiating that gross receipts reduction year versus year will require really that additional application at a minimum. So we have an FFCRA question. We'll address that here in a second. The next topic we're just going to go over from a high level is FFCRA extension, as well as the employee tax retention credit. So the FFCRA has been extended through the end of March of 2021. So this is that paid sick leave, whether an employee gets COVID and has to stay away, or they have to care for a family member. 80 hours, essentially 2 weeks, are covered under this in the form of payroll tax credits. This has now been extended through March of 2021. The question posted in the chat is a lengthy one, but I'll paraphrase and say that a company has hired a new employee to them in 2021. And their concern is if they have previously had benefit of the 80 hours in total. So the rule states you can only give an employee 80 hours cumulative. So if they got 80 hours paid via FFCRA in 2020, they can't receive it in 2021. This employer has since hired an employee, and they're concerned about previously them receiving this from a separate employer. So my best recommendation on this is you have the employee sign off attesting to the fact that they have not received the credits previously. If you can get that W-2 from them, which might not be available right now, that would be great. But I would have them sign and attest to it to cover you personally as the employer. And I think that's the best course of action you can take right now, hoping that the employee is honest. The other huge item out there is employer retention tax credit. So this was available to businesses throughout all of 2020, but was not used much by our client base. The reason why is most employers were using PPP, and if you had PPP funds, you were unable to use the employer retention tax credit. So this has been extended through June 30th of 2021. There are also retroactive changes related to this, where employers can now go back into 2020 and take advantage of credit during 2020 for wages they paid to employees. So eligibility is for those companies that have decreases not greater than 20%. Greater than 20%. So previously in 2020 under the CARES Act, you had to have a gross receipts reduction of greater than 50%. Now it is greater than 20% gets you eligible. So that casts a larger net in terms of who's eligible for this credit. You're also eligible for much larger credit per employee. So previously it was capped at $10,000, 50% of your wages paid to an employee for the year. And that was capped at $10,000. So the most eligible was $5,000 per employee. Now it's 70% of employee wages per quarter, up to $10,000. So you can get up to $7,000 per employee by keeping them on your payroll. So a huge change. Again, previously a company that received the PPP loan was prohibited from claiming this credit. Now, if you have the PPP loan, you can use this credit. You just can't use the wages for the same purpose. So if you use wages for the PPP, you can't use it for the employer retention credit. So this is something to connect with your CPA on, something to connect with your payroll company on. Again, this all runs through payroll tax credits. So as much as you can coordinate this up front, quantify it, and alert the payroll company to withhold, you'll be improving cash flow related to this credit. So more of this will come. There's some further documentation and support from the IRS in this category, but wanted to at least give awareness to our participants on the call today that there's a lot that we see our client base being eligible now with the changes related to the employee retention tax credit. So what I want to do is jump over to PPP2 highlights a little bit deeper. And so we'd love to hear a deeper dive from Tommy and Derek at this point.
Okay. Sure. So I'll start off with just a little reminder on what's included in payroll costs. You know, Derek mentioned it's 12 months of payroll costs you're allowed to include, but you know, it was back in April, May we were doing all this, so it's been a while. So payroll costs, what's included is your gross wages, group healthcare contributions. They have added a couple more specifications as to what's included in the group healthcare. Also, your retirement contributions and state and local income taxes is included. People may forget we did this back when we did these applications, because a lot of the forgiveness applications we're only including gross wages to satisfy this, but you get to include all those costs up front to calculate your 2.5 months of payroll costs or 3.5 months of payroll costs. And then the other nuance that we have here with these loans is to qualify for these loans, you have to, in addition to having 300 employees or less, you have to show a 25% reduction in gross revenue or gross receipts from a quarter in 2020 to a quarter in 2019. So when I think about this, a lot of companies, due to government shutdowns or the stay-at-home order, may have had to close their doors for periods of time during the second quarter. So it's likely if you do qualify, the second quarter may be the one quarter where you really saw a drop in revenues or receipts year over year. So that's one to look at. But really, it's, as far as we know at this point, it's any one quarter during the year. So if the fourth quarter was a big drop for different reasons compared to last year's 2019, and you can show that decline of 25% or greater, that would help you qualify. The one thing that is still floating out there is the economic uncertainty clause or economic necessity clause for this. So if it's possible that if you had a big decline in the second quarter, but you're now doing really well, that there could be some type of requirement that comes out when they put these forms out. But at a high level, the initial qualification would be a decline of 25% or greater for one particular quarter.
Okay, we're next going to move on to the eligible expenses that PPP loans can be used for in order to attempt to get full forgiveness of the loan. Tommy already indicated that the first area, which is the same as what we looked at with the original PPP back in the spring, is payroll costs. Tommy already explained that generally includes wages, health insurance, retirement contributions, and some small payroll taxes, such as like unemployment insurance being paid by a business. So that's what we call the main bucket of costs. And as you might recall, payroll costs need to be at least 60% of your costs used in order for forgiveness. Beyond that, there's the non-payroll cost areas where that really I'll break into two areas. There's the same non-payroll cost as were in the original PPP program back in the spring, which generally includes rent, mortgage interest, and utilities. Those are the areas that, you know, as we went through this process and things evolved through the spring and summer, there were a lot of gray areas on what was included in those types of costs, particularly in the utilities area. You know, did that include just gas and electric? Ultimately, we found out it included a number of other potential categories, such as transportation costs, cell phone costs, that type of thing. And there was clarification from the SBA throughout the summer on what can be included as an eligible cost under that non-payroll cost area. Beyond that, now there are it's an expanded areas for non-payroll costs, which generally go to the problems that businesses have faced during the pandemic, notably in two areas, worker protection costs and costs for what some commentators are calling adaptive investments. So those types of costs are now eligible beyond the previous small area or areas in the non-payroll costs of just rent, interest, and utilities. You can now go beyond that to infrastructure type costs. In the area of worker protection costs, essentially the key criteria is whether it enables a business to comply with health rules, be it social distancing or worker protection, masks, and surgical gowns, and the variety of things depending on the type of business that could be needed in their particular operations. Beyond the employee protection costs, the area of adaptive investments could include things that, again, would enable the business to comply with government requirements related to sanitation standards or social distancing or customer safety, things such as drive-through windows, indoor or outdoor space to expand. Obviously, think of the restaurants that have been adding outdoor tents and that type of thing. Also included are indoor or outdoor ventilation or filtration systems. Physical barriers such as plexiglass installation that you see up in a variety of retail locations. Those types of costs could all be included in this broad area of what they're calling adaptive investments. So that's the main area of the expanded non-payroll costs. Additionally, there's one other interesting category that essentially relates to operations that would include business software, cloud computing, and HR and/or accounting software or hardware type costs. Again, these areas are, new. It's been in print in the Act. The SBA is certainly going to turn these into rules that will be expanded further and explained further in the very near future, and then certainly as the forgiveness process for this evolves, similar to what we saw back in the spring. Certainly, I'm thinking that a gray area could be these other operating costs, such as I said, business software, cloud computing, that type of thing. Exactly what is included in there that businesses can use as a covered cost. One area that we haven't yet hit on, and Tommy, sorry if I steal your thunder on this, but it's the covered period, which you might recall previously could be either 8 or 24 weeks, can now be, as we understand it, anywhere in between. So as I think about this related to the non-payroll costs, once that 8-week period back in the spring got extended to 24 weeks, many businesses were able to just focus on the payroll cost area in order to obtain forgiveness. So as it evolved throughout the summer, we found that the need to quantify and get documentation for non-payroll costs wasn't as important if you had a 24-week period to spend the proceeds. So that type of situation could come into play again, where even though there are these additional eligible expense areas, it may not become that important if you've got plenty of payroll costs to cover the loan amount and get complete forgiveness. So with that, Aaron, I think this goes back to you.
Thanks, Derek. I think there's some relief related to the forgiveness process, a simplified method. So we'd like to hear Doug some insight in terms of the simplified process out there.
Sure, thanks, Aaron. So for loans that are under 150,000, the SBA and lenders kind of been pumping the brakes a little bit on applications that for PPP round one, a lot of lenders have been essentially saying that they're not accepting applications currently, or while they kind of roll out the new forms. And we've been advising clients to do the same, just to hold off for now. There's going to be a simplified form, so there's no point in going and applying for forgiveness at this point. So we'd anticipate a form that's more simple than it is now. So probably one page, mostly requiring just simple certifications asserting that the funds were used properly in the proper manner, and that the funds were obtained properly and used properly. So it should simplify things. There could be requirements to provide some payroll support and stuff, as there has been for some of you that have already applied. So I think that it's always good to have up-to-date records and payroll costs ready in case they're needed. But it's definitely going to be helpful. I think that there's a simplified form, and also the fact that the lenders are a little more familiar this time around with the process. So I think that things should go hopefully pretty smooth here in the next few weeks to months.
Yeah, so really the key takeaway is if you have a PPP loan round one under $150,000, our stance with clients is to hit the pause button. You're going to spend more time and effort submitting an application now than you will with the new form. And the new form, based on the bill, SBA has to keep this under one page, has to be one page. So it's going to be a simple form. It's going to require not a ton of effort to get completed and turned in. And so most lenders are forcing you to wait. And so you're either gonna have to force to wait, or we're recommending you wait for that new form, and you'll have a much easier, quicker process. So want to just address a few other questions hanging out there. Tommy, are 501c3 organizations eligible for PPP2?
So what I've seen is it's the 501c6 right now is what I've seen out there as far as the bill.
Okay. And this question may be for any of my panelists here. How does the qualification eligibility for PPP2 work again regarding the 25% reduction in revenues?
So I think I also saw someone ask if it was calendar quarters as well to go with it. And it's so you look at your third quarter, fourth quarter of 2020, and you would compare it to that applicable quarter of 2019, and you'd have to have 25% or greater reduction in your revenues or gross receipts. It only needs to be one of those quarters year over year that showed that reduction ultimately.
And to
Yeah,
clarify,
sorry, Aaron. The issue of, I saw there was a question about gross receipts and versus revenue. And at this point, we haven't seen anything that clarifies what is meant by that, correct?
No, but it mentions both as options.
Yeah, so it could be cash basis or accrual basis.
Yeah, I think that's what they're getting at. Yeah.
it looks like there's the flexibility there for both. Again, with when the form becomes available, we might know for sure, but it seems like right now that you can be accrual or cash based on the definitions out there. So,
Aaron, there's a question that I can take about the 12-month period for calculating the loan amount, and whether you can include January or February and look back 12 months. Essentially, at the date you do the application, it would be the 1 year immediately before the application. So if you're doing it in January, as I said earlier, it would be calendar year 2020. If you wait till February, then it would conceivably be February through January of 2021. So there apparently will be some flexibility built in based on that.
Thanks, Derek. Yeah, so you can do calendar year 2020 or a trailing 12 months depending on when you submit that application. So another question out there is, is it a requirement to have lower gross receipts in 2020 compared to 2019 to be eligible for the PPP2? So yes, I mean that's the biggest item there for eligibility is you do have to have that gross receipts decline quarter versus quarter, and it just needs to be 1 quarter at this point. So. An accounting question, we received our loan forgiveness and the loan was paid in full on 12/22. What is the credit side of the adjustment to zero out the loan to the books? So you'll be debiting your loan, and zeroing that out and then crediting other income. So we want that, it should be not in your revenue. It should be in other income. So below the line, you'll have, operating income and then other income expenses. It should fall in that bucket. And from a tax standpoint, it'll just be an M1 adjustment. So you'll have net income per books, and then it'll be an add back in the M reconciliation. Related to PPP2, obviously getting prepared for it is important. So we'd love to hear from Tommy, our recommendation on what we've been advising clients to do right now, and participants on the call today, what they should be doing to take the appropriate measures to be ready for round 2 when it becomes live.
Yeah, so with this next round of PPP, we know in general the requirements of how you're going to calculate your loans. There may be some different things with the ultimate form or some stipulations the SBA has, but we know what can be included as far as what your eligibility for a loan would be. So what we're recommending now is, even though the banks aren't going to be ready for a week, 2 weeks, 3 weeks, whatever it may be, depending on which banks you use. And I've heard some of the regional banks may be ready before the large banks as well. So you need your income statements year over year. By quarter, you're gonna need to show that revenue reduction. That's kind of the first thing you're gonna need to be able to show when you're doing this. So working with your CK professional as far as generating those income statements, comparing that year over year quarter to show that revenue decline, that would be step 1 as far as when I'm looking at this. And then the next thing is payroll costs. You need to gather your costs for your gross wages, your healthcare contributions, your retirement contributions, and your state and local income taxes. You may have had some of this when you did your package before. Some of the clients that did it with us, we have some information for 2019 already available for them. But if you did it on your own, make sure you've got that together. And what you need to consider is, like Derek was saying, is there's the option of 2019 or your trailing 12 months of wherever you apply. I would recommend running both those numbers. We could help show you what would be more advantageous. And as far as what's favorable, it's whatever one has more payroll costs of the 2 options. That's the one you're going to want to pick. And so we could work with you to show those 2 things to do that. And really, you can get all this stuff together. The other thing is you need to have your payroll tax form 940 and 941 to do this. So getting all that together right now would be really important, I would say. And then the other thing is, my best guess, based on everything that's happened, the evolution of all this PPP stuff, is these applications are going to be more electronic than they were last time. I think because they developed all these portals of different banks, that they're probably going to streamline the process and make it an online application. I know some had paper forms you may submit. There still could be that, but I think a lot of it's going to be submitting online because they developed these sophisticated portals to use for it. And hopefully the process will be better. But like I said, I think the best thing is to get all your information together. So whenever you get the notice from the bank, you can go ahead and do this. I would also recommend reaching out to your relationship manager at your bank, letting them know that you are interested in this, you think you qualify, and start that process, because that can only help when you ultimately go to apply for these loans.
We've got some other questions related to PPP2. So regarding the threshold of quarter 2019 versus quarter 2020 gross receipts decline, if the PPP loan is forgiven and shows as other income, does that affect the gross receipts for the quarter in which it is received? So Derek, I think this would not be included in gross receipts, but if you can let them know.
Correct. Yeah, that sounds appropriate, Aaron.
Yeah, so again, your gross receipts are your normal revenue line items. So again, another example would be a BWC deposit. A lot are getting many companies got those in December. All companies that have BWC coverage got that in December. That should be something that doesn't hit your gross receipts, your sales line item. It goes into other income. on your financial statements. So that would be something that wouldn't be counted against you when comparing quarters versus quarters. Question on employee retention tax credit, any revenue reduction requirement. So the revenue reduction requirement is 20% in 2021. And so greater than 20% in 2021, and in 2020, it was greater than 50%. Doug, I'll throw this question to you. Is a quarter any consecutive 3-month period, or does it have to follow calendar quarters? I have a 25% dip in May through July. Does that qualify?
I believe from what I've seen, it's got to be a calendar quarter.
Correct. I think we all agree on that. It's regardless of your reporting quarters, you have to follow calendar quarters for the PPP. Derek, you covered some of the expanded costs. Question is Zoom call equipment investment adapting from in-person meetings for sales purposes? Would this be an expanded cost?
Well, it sounds like a potential gray area there, but as they've defined operational expenses so far, I would say likely yes. I mean, under the heading of software, cloud computing, and other HR needs or business operations needs, then certainly some businesses need to look at that to have that type of expense. Again, I go back to the issue of if you have a 24-week period of time, will you need to get to that level of detail for forgiveness, or will payroll costs and the other non-gray areas get you to 100% forgiveness anyways?
Thank you. Question on the necessity clause. I'll throw this to Tommy here. It's a so the question is, how worried or concerned are you about the necessity clause regarding PPP2? Talking to clients, they have a way to justify the necessity, even though the client is still in business. One client told me, sure, I need it. I might not need it today, but I do not know what tomorrow will bring. The client does meet the 25% reduction for 1 quarter. So Tommy, any additional commentary on the necessity clause?
Sure. So I think, there is some gray area as to what necessity is. It doesn't mean that your business is going under as far as an economic necessity clause, or that you've had to lay off people rapidly, or something drastic like that. I think what I think about is, if you show a 25% reduction in say the 2nd quarter, but then for whatever reason with COVID, certain types of your business really took off this summer, right? And you had a great 3rd and 4th quarter, potentially even better than you ever had before. In those cases, I think they might question your economic necessity for what you had. But if you had that 25% decline in a quarter, and you've been a little bit under, or even just close to where you were previously, I think you can prove that economic necessity because of the uncertainty that's going on here. I think the one thing to just pay attention to is if your business did start to increase to higher levels, that's probably where you're not going to be able to justify your economic necessity, is because it really looks like you're, for different reasons, COVID had a positive effect on your company in the end. So, there's different ways to justify why you need it. And if you can show in the future, maybe that you've lost contracts or different things, I think it's just building your case as to why you need it. I think you can work with your CK people as far as doing that, but that's how I would look at it in general.
Great, thanks, Tom. Yeah, with the uncertainty out there, I think a lot of, if you had a 25% decline, and if there still is uncertainty going forward, which I think most, if not all, can really hang their hat on some level of uncertainty, documenting that in some way, will make you feel better about the necessity clause. So we already addressed this one, but when do applications begin? So yes, sometime in January, we're expecting the process to begin. We're waiting for the forms, and they should be released in the next week or so, and then the process then the lenders will have to be ready at that point. So sometime in January is the timing. Derek, I'll ask this question to you. Must the application for PPP2 be made only after applying for forgiveness of PPP1?
No, it's our understanding that you can go forward with applying for PPP 2 now, because, and Tommy, jump in if you have any further thoughts. For those of you who were on our last webinar, we talked about the application process, which really businesses can have until next summer to actually apply for forgiveness. As an example, if you weren't on that webinar, essentially, if you had a covered period under PPP 1 that ended in October, you have 10 months after the end of the cover period to apply for forgiveness, which would take you through next August. So you do have that overlap. Tommy, have you heard any insight on that dynamic?
So you're correct, Derek. You're allowed to apply for PPP 2.0 even if you haven't applied or received forgiveness on your first loan. I think in general you would have exhausted that, your covered period would be over by now, and you are allowed to apply for this second loan. That doesn't prohibit you. Some companies have already done forgiveness, and that's great. But if you haven't, it's not a factor to prohibit this application.
Right. And as we talked about before, certainly patience is important to be able to try to get complete forgiveness on PPP 1 in the first place. So businesses should take the extra time, particularly if they're, need to come up with ways to get forgiveness, such as if you had an FTE reduction, but you had employees who left who might be one of those reduction exceptions that we talked about on our last webinar, then certainly take the time to do that to get complete forgiveness and not worry about the overlapping period with PPP 2.
Thanks, Derek. A few more questions out there. This is related to PPP 2 loan amount. Is it still, so please confirm that a company who wants to apply for PPP 2 loan is still eligible to take advantage of the FFCRA payroll tax credits up until time they receive the PPP 2 loan funds. Knowing once that the PPP 2 loan funds are utilized will disqualify a company to use the payroll funds for forgiveness and for the credit simultaneously. So the key point to know is FFCRA and PPP, you cannot double dip with the funds. You can't double dip with the wages, excuse me. So if you're applying in January and you have the FFCRA credit going on, you just can't use those wages for PPP 2. So you can do it up until you receive the funds, just you can't use the double dip on those wages. This is one with lenders. Would you recommend using the same bank we used before, or does it not matter? We use a big bank and it took a lot of time. Might want to switch to a regional bank, as just mentioned. So again, we saw different banks processing these at a different pace, at a different level. If you had a bad experience round 1, you may have the same experience round 2. So the key thing is, I think, getting organized now, be prepared, and as soon as it becomes available, you jump on it. And if the big bank that you've always used isn't responsive, then maybe you should consider using somebody else. There's no requirement to have to use the same lender. You can, and it doesn't have to be the lender you've always used for your banking relationship. So we recommend being prepared and being adaptable to utilizing somebody else. I'll throw this to my panelists. With PPP 2, if you further reduce FTEs, so the FTE reduction, will that negatively impact your forgiveness?
Is that what the second round of PPP they're asking?
Yes.
So I think it will, but they haven't released all the forgiveness rules that we've seen yet. So I think there could be some changes with those. I would think conservatively, yes, that could reduce your forgiveness again, but they may put some different rules, especially with certain industries on this next round of funding. I haven't seen that there's been the forgiveness rules released by the SBA.
Yeah, I agree that it's what we've seen so far indicates that the rules will be similar. both whether it relates to forgiveness or loan duration. If you don't have complete forgiveness, everything in those areas would seem to be status quo at this point.
Does FFCRA benefit payments get included in the average payroll? I would believe that if it's a wage that you incurred, it would be a qualified cost for this. So it's looking at payroll reports. You're looking at payroll reports. You're turning in payroll reports, and so you're tying into those gross wages on those payroll reports. So we would anticipate that'd be a qualified payroll cost for PPP round 2. I want to touch on a few as we're getting close to the end of our webinar here. I want to touch on a few changes on individual and business provisions related to the recent bill. With time permitting, we'll address a few more questions as well. So with the recent bill, one important change for those that are unemployed is an 11-week extension of unemployment insurance. So was in place for most of 2020, and we now have an 11-week extension on unemployment benefits. One thing out there as well is the stimulus payments, the stimulus checks for taxpayers. So it's an additional payment up to $600 per individual and qualified child. There is thresholds, so $150,000 for marrying, filing joint taxpayers and $75,000 for single filers. So you can get up to $600. Above those income levels, you start to phase out. So taxpayers start receiving those payments this week. If you think you're eligible, you should look into it, see if it hit your bank account. If not, know that when you file your 2020 taxes, there will be an adjustment there if you did not receive the payment and you were rightfully due the stimulus payment. So charitable contributions, a small one for individual taxpayers. Again, it was $300 above the line deduction for those that are standard deduction. In 2020, it's been increased to $600 for marrying, filing joint taxpayers as above the line deduction in 2021. For businesses, the business meals expansion deduction. So business meals are 100% deductible in 2021 and 2022. So something to encourage taxpayers to go to the restaurant industry that is struggling right now. So something business owners can get a bigger bang for their buck in terms of the meals expenses moving forward in 2021 and 2022. So one other thing I want to just touch back on before we answer some more questions is really that employer retention tax credit. So it's something really that a lot of taxpayers overlooked during this year. A lot of business owners overlooked because of the PPP. Those that were hit hard, that saw their gross receipts decline by greater than 50% in 2020. There may be potential amended payroll tax returns that can be prepared to get some additional tax dollars back, or you need to properly file your fourth quarter payroll tax return to get these credits back. So again, a lot of our clients' covered period ended in middle third quarter, early fourth quarter, and had over greater than 50% decline in receipts. They'd be eligible in that fourth quarter to have some payroll tax credits come back to them. And then moving forward into 2021, the requirement is greater than a 20% reduction. So it's reduced down to 20%. So you don't have to be 50%. You can just have a 20% reduction, and the credit is much higher. So again, something to explore, to look at, to see if you qualify, and get some more payroll tax dollars back, in 2021 and 2020. Want to address a few more Q&A that are sitting out there as well, with 5 minutes to go here. So regarding quarters, I think we've touched on this several times, but does it have to be 2020 third or fourth quarter comparing to 2019, or is it any quarter? So Tommy, can you just touch on which quarters you have to compare to again?
if you were in business for all of 2019, all of 2020, it does need to be the same quarter of 2020 compared to the same quarter of 2019. There are certain rules that are supposed to come out if you started business at a different point in time. Say you started at some point in 2020, that there are different rules for that. But if you were in business for both years, it does have to be the same period.
Question on who is eligible or requirements to receive the remaining forgivable EIDL loan advance amount of $10,000. So anything further on the EIDL advances that are out there from our panelists?
Yeah, so for the advances that you received before, they're not going to be deducted from your PPP loan, as they previously had said. If anyone went through forgiveness and I know I had a couple clients and they did get that deducted, and they said the banks are supposed to help you to forgive that portion of the loan. So it's not supposed to reduce that. So I think that's one of the biggest changes that happened with this, is it shouldn't reduce ultimately. I think what you'll see is in the new portals or the tweaks to the loan application, this won't be included as a requirement to input.
Panelists here, anybody can jump in on this one. How would a first-time borrower calculate PPP loan amount if they started business in February 2020?
So I think that's based on, you just take your average payroll for the period of time that you've been in business and then calculate it. I think that the example would be, so if you started in February, you'd calculate your last 11 months of payroll and then average it out and then take 2.5 months of that. So it'd be based on how long you've been in operation.
And related to the eligibility based on the 25% reduction, it appears as though if you opened in 2020 prior to February 15th, then you're going to compare your first quarter receipts to your remaining quarter receipts. That's what we've seen written so far. And base any reduction, and that's given that the pandemic started about 2/3 of the way through that first quarter, that's a bit of a tricky calculation, but that's as it's written so far that we've seen.
Well, I want to thank our panelists for their time today. We've touched on a lot of items here, addressed as many questions as we can. We know there's a few more hanging out there, but we want to encourage our participants to reach out to us, whether you're a current client, business contact of us. We are happy to address any and all questions. We're here to be resources for the community and for our client base. And so we are encouraging you to reach out to our coronavirus crisis team. The email's listed there, ckcrisisteam@corrigankrause.com. We also encourage you to visit our COVID-19 website, corrigankrause.com/COVID-19 updates. Again, you go to our main webpage, you'll see an alert to go to our COVID-19 landing page, where we're constantly adding updates and resources as we continue to move forward. So as the applications come out for PPP2, we'll be giving further information, templates, calculators, to help our clients work through this. Anybody else on the call is more than happy to jump on there and pull that information down. So we'll also be getting out more information on the employee retention tax credit, which is a big item for a lot of clients. And as more information becomes available and how you can take advantage of that, we'll be sharing information as well and giving appropriate resources and guidance on that. So again, I want to thank my panelists for their time and effort on this, as well as Megan Hiles, our business development manager. And we hope everyone is having a good 2021, and thanks for your time today with us.